Good morning, 230 class. Today, we're going to go into chapter 3, and this is a very ambitious, intense chapter. I urge you to consider tutoring or some outside help because this is quite a lot to do in the compressed semester we've got going here. So I'm going to wait a moment and see if I get any customers. And if not, we'll just do the lecture without the feedback of an audience, okay? Well, that was a shame Brock Purdy got hurt yesterday for the 49ers, huh? But the Eagles are tough. Kansas City was a little lucky to win that game yesterday, so I still think it's a good matchup, though, the Chiefs and Eagles. Too bad you can't watch it because you'll be very busy studying. Okay, with that in mind, I'm going to get going here. If somebody joins me now, that's fine. Cold day in Santa Barbara for those people out of touch here. So let me share the screen. Share screen. Okay. Like I said, this is a very intense, what's the word I want? Intense, comprehensive chapter. I'll break it out as best I can and go over it. And hopefully you can look at this video and get some help. Let's get going here. Adjusting journal entries. These always drive the accounting students crazy at first. They're not difficult until you learn why you're doing these entries. The why is the key to this. So let's try to understand it as we go along. Oh my goodness, look at all the things we're going to learn today, huh? Conceptual, analytical, my goodness. So let's keep going, break it out, divide and conquer, huh? Explain the importance of periodic reporting and the role of accrual accounting. The accounting period, it can be a month, it could be a year, it could be a quarter, it could be any period that a company chooses to break out its financial activities. Doesn't have to be a calendar year. Accrual basis versus cash basis. First thing I'm going to say, we're not going to talk about cash basis at all. Cash basis is not GAAP, and a serious company cannot exist on a cash basis. You will inevitably cash basis yourself out of business if you do things on a cash basis. Very small companies can kind of get away with it, but otherwise, no. What we teach is accrual basis accounting. Accrual accounting. If anybody asks what you're learning accrual accounting, which is commensurate with GAAP, generally accepted accounting principles. Revenues are recorded when the products or service are delivered. Expenses are recorded when they're incurred. In other words, when they take place. The cash is irrelevant to these transactions, okay? You might have a revenue and cash happening at the same time, which is great. But if someone's going to pay you later, that's a different story, okay? So let's take a look at a few things here. Accrual basis. Well, I don't like this. I don't like the slide too much. I don't know if you can read this. Paid $2,400 for a 24-month insurance policy on an accrual basis. $100 of that 2,400 divided by 24 months. 100 of that insurance expense is recognized in 19, 20, 21. In other words, $100 a month, okay? Recognizing revenues. Again, revenues recorded when the goods or services are provided to the customer and at an amount expected to receive from the customer, obviously. Recognizing expenses, the expense recognition principle requires that expenses be recorded in the same accounting period as the revenues are recognized as a result of those expenses. This is called the matching principle. You're matching revenues and expenses. You want all of the sales to be recorded and also all of the expenses incurred in the period you made those sales. This matching of expenses with the revenue benefits is a major part of the adjusting process. Framework for adjustments. Okay, they're going to talk about 4 different kinds, and I think they break it out fairly well in the following slides. We're going to have a deferral of expense, a deferral of revenue, accrued expenses, accrued revenue. A deferral means something. A deferral in our case means cash changed hands, but nobody did anything yet. Cash changed hands, but no revenues or expenses are immediately recorded. Accruals, an accrued expense, an accrued revenue, means that an expense has occurred and we're now recognizing it even though we haven't paid it yet. Same thing with accrued revenue. We might have some accrued interest from somebody. Adjusting entry for deferral. Prepaid assets, okay? Deferral, I'm going to say this a few more times today. Deferrals, money has changed hands, but nobody has yet recorded a revenue or expense because they haven't earned it yet. Prepaid expenses are assets paid for in advance of receiving their benefits. Prepaid insurance, prepaid rent, prepaid supplies, okay? Whenever you buy an insurance policy, whenever you purchase supplies, those are always assets. They are assets, okay? So you're going to debit the appropriate prepaid asset. It's a current asset. So what do we do with the prepaid insurance? Step 1, know what's in the current balance. Fast Forward Company paid $2,400 to cover insurance for 24 months that began December 1. So it looks like it's $100 a month to me, huh? So Fast Forward recorded the expenditure as prepaid insurance, which is correct. That is an asset. It does not become an expense until you get the benefit of the insurance policy, meaning as the policy lapses each month. So it's $2,400 policy, 24 months, that's $100 a month. We are now going to have to make our first adjusting journal entry. We're going to have to reduce this prepaid insurance by $100 and debit the appropriate expense. And here it is right here. The balance in prepaid insurance should equal now $2,300. Now we've come to the end of December. We are going to debit insurance expense for $100, credit prepaid insurance for $100. So the prepaid insurance account is now $2,300, and the expense for the month has been recorded. We're going to do that every month for 24 months. Next month, we're going to write the same exact journal entry to record the expense of this prepaid insurance policy, okay? The insurance expense is debited $100 to recognize the amount of the coverage we had for that month. We were insured the month of January. We got the benefit of it. Thus, we record the expense. And they're just showing you again, adjusting for prepaid insurance. You debit insurance expense. The income statement will show $100 of insurance expense, and the balance sheet will show that balance of $2,300. There's your journal entry. Debit insurance expense, credit prepaid insurance. You have the same thing going on with supplies. You can have it in other areas too, like prepaid taxes, prepaid rent, but we're mostly going to talk prepaid insurance and prepaid supplies, okay? The adjusting entry for prepaid insurance, huh? Wow, they're really enforcing this, right? Here they're showing it in the T account, general ledger form. Here is your journal entry. Take a look at that journal entry. You debit insurance expense, which increases the expense, and you credit prepaid insurance, which reduces the asset. And I'm hoping you're all pretty conversant now with debits and credits. Otherwise, it makes it quite a bit harder. So hang in there these first couple of chapters, okay? Adjusting for supplies. It's the same exact thing. We bought $9,720 worth of supplies in December, some of which were used during December. So we have to figure out what the expense is for December. And the way we do it, we're going to go out and count what's out there at the end of the month. We had 9,720. The physical count shows we still have 8,670. The difference between those two numbers is $1,050. In other words, we purchased 9,720, and that asset was there at December 1st. At the end of the month, we go out and we count what's out there, 8,670, meaning we must debit supplies expense and credit the prepaid supplies. Okay. Think of these adjusting journal entries as a search for unrecorded expenses and revenues, mostly expenses. Okay. And here they're showing you the journal entry. And I think it's good to look at that journal entry. You debit supplies expense, you credit supplies. So I think these are pretty good slides in terms of demonstrating it. Have this maybe have this available when you're doing your homework as you're starting to learn this, because adjusting entries can be tricky. Hey, let's talk about depreciation, huh? Depreciation. When you buy a truck, a car, a big piece of machinery that's going to last you many years, when you buy a building, those are all called fixed assets. They're going to go on your balance sheet in that category, fixed asset. It means an asset that has many years of useful life over which you can depreciate the asset. Depreciate. It's an expense. Instead of instead of expensing the cost of a plant asset, like a car or building, in the year it is purchased, we allocate or spread out the cost over the expected useful life. And there's a little formula there. But before we talk the formula, let me just give you a simple example. We bought a car, a company car, for $100,000. We expect that car to last us 5 years, and we're going to depreciate it over what's called a straight line method. We're simply going to take that $100,000 car, divide it by 5, get $20,000, and that's going to be your depreciation expense. It's as simple as that. But you're going to have to just do a few entries to get comfortable with it. The formula for straight line depreciation, and there are numerous methods of depreciation. Straight line, the asset cost minus the salvage value divided by the years, the useful life. Salvage value. Useful life. Let's get the useful life. When you buy an asset, you have to come up with an estimate, and it is an estimate of its useful life. The period of time that an asset is expected to help produce revenues. In other words, the amount of time that you think the car is going to last. Okay. Useful life expires as the result of wear and tear, or because it no longer satisfies the needs of a business. For example, if you bought a machine and you had it as a 20-year life, and after 10 years, you no longer make that product and have no use for that machine, well, that would be a write-off of that machine for 10 years worth. So let's see what we got here. Salvage value, right? Salvage value, residual value. That's what it's called, residual or salvage value. It's what we think the market value of an asset will be at the end of its useful life. We call it the scrap value, residual value. Remember that $100,000 car that I just babbled about? Well, we said to ourselves, when that car is beaten to heck after 5 years, we think somebody will give us $5,000. A junkyard will come in and give us $5,000 for it. That is the salvage value, the amount of money we expect to cash in at the end of the life of the asset. Okay. The key thing to remember is we do not depreciate the salvage value in all methods of depreciation. So let's see what we got going here. Adjusting for depreciation. Step one, they bought equipment for $26,000. Estimated useful life of 5 years. Okay. Wow. The salvage value is $8,000. The equipment is expected to be worth about $8,000 at the end of 5 years. So now they bought the machine December 1st. It's the end of the month. We have to record the adjusting journal entry. Because Fast Forward expects the equipment to be worth $18,000 when the 5 years are over. Only $18,000 of the cost needs to be spread over the next 60 months. So we would divide 18,000 by 60, I guess, to get the monthly depreciation. So let's take a look at it. This is an important slide. Fast Forward purchased the equipment for $26,000. We're not going to depreciate the salvage value. So the depreciable amount, the net cost they're calling it here, is going to be $18,000. Now, the asset, the equipment, has a life of 5 years, expected to be worth $8 at the end, and they're showing you that same transaction. $26,000 minus 8 is the depreciable amount. We divide that by 60, we come up with $300 a month. So every month for the next 60 months, you have to post it to your general ledger so it looks like this. You're going to debit depreciation expense, and you're going to credit an account called accumulated depreciation, throwing in another new account. Record adjusting journal entry of $300 for 1 month. The depreciation amount of $300 is credited to accumulated depreciation instead of the equipment. You see that equipment there, that $26,000? That's never going to change. That number is going to be the same. What's going to offset it, though, is what's called a contra asset named accumulated depreciation. This is an asset with a credit balance. Thus, they call it a contra asset. There are just a few of them, and you're going to learn them all in the next 8 weeks, hopefully, huh? Not too many. So at the end of the month, we debit the expense, we credit accumulated depreciation, because you never, never, never credit the equipment unless you sell it, get rid of it. So take a peek at the adjusting journal entry. We debit depreciation expense for $300. We credit the accumulated depreciation because you never credit the original cost of an asset. Never credit the original cost of the asset. What's going to be reduced every month is called the net book value. $26,000 minus the $300 is $25,700. We would call that the net book value. And here they're giving you a nice demonstration of it. In this particular place here, it's after 3 months. 3 months. 3 times 300 is 900. The original cost was $26,000. The accumulated depreciation was $900. Therefore, the net book value, after 3 months of depreciation have been taken, the equipment is shown net of accumulated depreciation. Net book value. Remember, you never credit the asset itself. Okay, those were introductions to deferrals. We'll go a little more here. We had those were deferrals of expenses that we just saw. Deferrals of expenses. Okay. Money changed hands, but nobody was in a position to record either revenue or expenses because no work was done. Or we never got the benefit of the asset until the beginning of the following period. Prepare adjusting entries for deferral of revenues. We'll have a little fun with unearned revenues. Ooh. Deferral of revenue. Unearned revenue represents cash received in advance of providing products or services. You go to a lawyer and you say, I want you to make out a will for me, a living trust. And the lawyer says, okay, I need $1,000 just to get started. Well, when you give him that $1,000, he's going to take that money and he's going to debit cash, of course, but he can't credit revenues because he hasn't even begun to work on your case. So he's going to credit an account called a liability account called unearned revenue. Unearned revenue is a liability account. The lawyer has a liability of $1,000, not in cash, but $1,000 worth of legal work. So let's take a look at the steps. Fast forwards client paid 60 days in advance, covering 2 months, it looks like. And when the lawyer got the money, cash, $3,000, we debit, and we credit unearned revenue. Here they're calling it unearned consulting revenue, but the key 2 words you need to know, unearned revenue. And we could say as our explanation, we received in advance for services rendered. Now, step 2, fast forward earns payment as time goes by. After in December 31st, 5 days service is earned, or $250. The adjusting entry is going to reduce the liability and credit revenue. Let's take a look at this, see if we can make some sense of this. Let's look carefully at our entry here. We learned how to do deferral entries for expenses. Now we're talking revenue, unearned revenue, very common. We are going to debit unearned revenue for $250. The lawyer made a phone call for us, charged us $250, these guys, okay? Revenue, the liability account has been reduced. The balance sheet will show $2,700 of the liability called unearned revenue. And commensurately, the revenue went up $250. Now we have the income statement will show, in this case, 6050 unearned consulting revenue, not unearned, earned revenue. And here is the journal entry. Adjusting entry recorded on December 31st to transfer $250 from unearned to earned consulting revenue. Debit unearned revenue. We know now that debits reduce a liability, and we're going to credit revenue, knowing that revenues are increased by a credit. Now, we learned about deferrals. Deferral, once again, money has changed hands, but nobody has earned anything or incurred an expense at that point you got the money, okay? Here, we're going to learn about adjusting entries for what are called accruals, accrued expenses. Here, we recognize an expense took place or a revenue has been earned and then recorded. One thing with adjusting journal entries, a little tip, you never have cash in an adjusting entry. Students get a little mixed up and they start throwing cash down there. No, cash is never going to show up on an adjusting journal entry. Accrued expense. These are costs that are incurred in a period that are both unpaid and unrecorded. What could that be? Well, we're going to learn a couple things. How about the month ends and we're looking at our trial balance and we see we don't have any utilities expense? Well, how can we have any expense? We haven't gotten the electric bill yet, nor is the bill going to come probably in the middle of the next month. We can't wait 2 weeks for the electric bill to prepare the financial statements. So we're going to have to estimate. Yes, estimate. Some financial statements include some estimated numbers, as long as they're estimated logically on what accounting calls a systematic and rational basis. For example, look at the last couple of electric bills. They've been running about $500 a month. This month is colder. We're having a very cold. We had a very cold January. Maybe we need to bump up the accrual to say 700. It's just our best good faith guess. You can't make up an outrageous number to create a result. They're going to start us off with an accrual that you will probably catch on to, I hope. You're all working people out there one time or another. Probably most of you are working right now as you go to school, which is great. Fast Forward pays its employees $70 a day. It's a 5-day work week. And they pay every 2 weeks. Okay. 12/31 is a Wednesday. So 3 days' salaries are owed at year end, which equals 70 times 3, right? You earn money on the 29th, 30th, and 31st of the month. Even though you're not going to get paid for probably two weeks or more, we have to recognize that we incurred that salaries expense. So we are going to write an entry where we debit salaries expense, credit salaries payable, preferably accrued salaries payable, but that's okay. Take a look at it in the general ledger. We had 1,400 salaries expense already. Those are the salaries they've already recorded, okay? Recorded and paid, we're done. But now we got to grab these 3 days at the end of the month. So we're going to debit the expense to increase it and credit the payable, accrued salaries payable, to bump that up from nothing to 210. The balance sheet's going to show 210 of salaries payable. The income statement will show 1610, the total expense now. Here is our journal entry. They're throwing a little complication in future payment of accrued expenses, okay? Accrued expenses at the end of one period result in a cash payment in the future. So we recorded a payable of $210, right? Now, a week and a half later, they paid the payroll. They paid the $700. So at that point, we will debit the liability account for 210 because we've already recorded that expense, and we record the rest of it here, the $490 and the total cash $700. Accrued revenues. Accrued revenues. Accrued revenues are revenues earned in a period that are both unrecorded and not yet received in cash or other assets. Remember, the deferrals, cash changed hands, nobody did anything. Accruals, something has been incurred and must be recorded, and we haven't paid for it or recorded it yet, okay? Fast Forward's customer agreed to pay $2,700 on 1/10 of the next year for, I think it's supposed to be or 1/10 or 1/10 of the next year for future services over the next 30 days. You have a typo there. Step 2, 20 days of services have been provided and earned, which totals 1,800. So they're calling this an adjusting entry. It's really not. It's just your basic accounts receivable that we learned in chapter 2. We're just going to debit accounts receivable and credit revenue. No cash involved. I don't know why these textbooks show these as an adjusting entry. They're really not. But take a look at it. It's good practice. We billed the customer for $1,800, and the customer is going to pay us later. Cash, $2,700. Accounts receivable, $1,800. Consulting revenue, $900. That's a lousy presentation. Here, what they're showing us here is when we finally received the money. Okay, we had $1,800 in receivables. When they pay the $2,700, we're going to say that $1,800 was put into receivables already. $900 goes to the revenue. Links to the financial statements. Let's take a little look at this briefly. Deferrals. Paid or received cash before expense or revenue recognition. And you could have a deferral of expenses, deferral of revenue. What are the deferral of expenses? That's your prepaid assets and depreciation. Deferral of revenue, that can be unearned, that could be interest. No, I'm sorry, that would be the unearned revenue. Okay. And you can have accruals. Accrual. We are now we don't have any cash right now. We have to record the expense with the debit and the liability with a credit. Okay. Let me just pop this down a little bit. Okay. That's the tough part of this chapter. But once you master the adjusting entries, you feel comfortable with them. It's a nice step forward, believe me. Explain and prepare an adjusted trial balance. Well, we know what a trial balance is now, right? We learned that in chapter 2. A trial balance is simply a listing of all the accounts in your chart of accounts. They're listed in order of asset, liability, equity, revenue, expenses, and they show a debit column and a credit column. And at that point, the only thing the trial balance does for us is prove our debits equal credits, okay? Now look at an adjusted trial balance. I'll try to make it a little bit bigger. I don't know if you can see it. An adjusted trial balance, huh? Here is the trial balance we did before any adjustments. And we have cash, receivables, we got the whole world there, okay? Totaling down. Now we did some adjusting entries just now. They are taking the entries that we just did on the earlier slides and demonstrating how you update the trial balance. Well, we had that $1,800 in accounts receivable. So that increased the accounts receivable from 0 to $1,800. There's your adjusted trial balance. Let's look at supplies. You had a balance in supplies of $9,720. Remember that number? And then they counted it and learned, excuse me. They counted it and learned they had $8,670 left over. So you credit the supplies. You are just going to take the unadjusted trial balance numbers and debit and credit your way across to the adjusted. Prepaid insurance, it was $100 a month. The asset's down to $2,300. Notice there's no adjustment for equipment, nor would there ever be. The adjustment, though, shows up in the contra asset account called accumulated depreciation, 300. Bring the 300 over here. Here's the unearned revenue, where we debit the liability and we credit the revenue account. So let's just go through these briefly, one by one. The first one they showed us was the insurance. You debit insurance expense for 100, and you credit prepaid insurance for 100. B, supplies expense. We record the supplies expense as a debit, and we credit the asset account to bring it down to its proper level. C, depreciation expense, 300. D, here is the consulting revenue. Here, we did some work finally. So we get to debit or reduce that liability account and credit the revenue, real revenue. And then accounts receivable, you should know that already. That's not really an adjusting entry. Debit $1,800. Then they put the $1,800 down here, and they don't have an account. So I'm assuming that's a botch up there. Now, what did we learn? We learned how to do a trial balance, hopefully last Wednesday. We just went through a difficult, tricky little area of accounting called adjusting journal entries. Remember, all companies do prepare adjusting journal entries. The reason you have to do adjusting journal entries is because there are simply some expenses, some revenues that can only be recorded at the end of the period, at the end of the fiscal month. Okay? Prepare financial statements now from the adjusted trial balance. Oh, look at this, huh? Preparing financial statements from an adjusted trial balance. Well, we're going to prepare the income statement using the revenues and expenses from the adjusted trial balance. We're then going to prepare the statement of retained earnings from the adjusted trial balance. And we're going to prepare the balance sheet from the adjusted trial balance with one exception. What changed? The equity. Prepare statement of cash flows later in the book. Make this bigger. Here is the adjusted trial balance, okay? Notice that it goes in the sequence of your chart of accounts. Cash, receivables, it goes from assets, liabilities, equity, revenues, and expenses. You see the account number in front of cash, 101, 106, and receivables, and then 201 for payables. That's very typical. Any general ledger I've ever seen typically begins 1 for assets, 2 for liabilities, 3 for equity, 4 for consulting, and then you could have maybe 5 if you want for selling expenses, 6 for admin. But let's take a look what we did here. You see that lovely black line there next to the 200? They're doing what I tell all my students to do. When you take this adjusted trial balance, draw a line above your first revenue number. That way you know everything below this line is your income statement. Everything above that line is your balance sheet. So that should be a pretty good tip. So let's see, they had revenue of 7,800 and 300. Let's see that flow into the income statement. And there you go. There's your income statement. We picked it right off the trial balance. Total revenues, 8,150. Total expenses, 4,365 for a very, very profitable month, okay? Let's do the statement of retained earnings. Again, we're going to have to look at the trial balance. And they have a beginning balance of 0. They had no equity at the beginning of the month, plus your net income, 3785. Notice they had dividends, though, 200. Dividends come out. So you now have a new retained earnings number, a new equity number of 3585. Statement of retained earnings. You start with the beginning number, which in this case is 0. You add the net income from the income statement, and then you subtract the dividends. So we now have our statement of retained earnings, a statement of equity, They're going to work, we're going to be calling retained earnings here. And then your balance sheet. Your balance sheet, you're going to take the $3,585, okay? And you're going to post it to your income statement under retained earnings. And then guess what? All you need to do now is copy all the numbers from here, except the equity number, which has changed. You copy all of everything down to that black line. The only thing that's changed is 0, 3585, and you're in balance. That's why it's important and crucial to understand why we do the income statement first, the statement of equity or retained earnings secondly, and then third, the balance sheet. Give me a second here. This thing's giving me a hard time. Closing entries, huh? You thought you were done with journal entries for this class, huh? Now we're going to go into closing entries. What happens here now, at the end of the month, we're all done. We published our financial statements. We don't have to work overtime like we did for a couple days maybe to get all this work done. We're finished. The last thing we need to do is prepare what are called closing journal entries. What do you close? You close everything on the income statement. In other words, you close revenues and expenses. What we mean by closing, we mean zero them out to another account. We are going to close revenues, expenses, and dividends to 0. And this is going to help summarize the period's revenues, expenses in the income summary account. In other words, we're going to take a revenue, which has a credit balance. We're going to debit it. Now it's 0. The credit goes to an account called income summary, which is just a clearing account. It will never have a balance on your financial statements at month end, and it's used just to collect the closing numbers, okay? So we're going to close, record the post-closing entries and the trial balance. Temporary and permanent accounts. Temporary. Those are the ones that we are going to close. And what did I say the temporary accounts are? The temporary accounts are your income statement items, all the revenues and expenses. And we got to close the dividends too. And you'll see that when we get there. The closing process applies only to temporary accounts. At the end of the month, all your revenues and expenses have changed to 0. Why is that? Because remember the profit we made of $35.85? What did we do with it? We moved it over to equity. We moved it over to retained earnings. That means that we have 0 now as a balance, if you will, for revenues and expenses. Every month begins with a clean slate on revenues and expenses, okay? The permanent accounts of the balance sheet, you don't touch them. You don't close cash or receivables. Close credit balances in revenue accounts to income summary, close debit balance and income statement to income summary. Let's think about that a second. All your revenue accounts have a normal balance of a credit. It's a credit that increases a revenue. So now we're going to get rid of that revenue with a debit. So we're going to debit the revenue account and credit income summary. We do the same thing with the expenses, only we're going to credit each and every expense and debit the income summary. At that point, the income summary balance will equal our net income, right? It's got the revenues, expenses. Now we close the income summary hopefully with a debit because we made money, and then we credit retained earnings, and we close dividends directly to retained earnings. Okay, I think this is a decent look at it. Let's start with the revenue. This business had 2 revenue accounts. So they're giving you a 4-step closing process, which you should have in front of you when you're doing your homework. Close income statement credit balances. Take a look. Consulting revenue was $78.50. The rental revenue was $300. We have to close them to income summary, and that gives you a total of $81.50. 78 plus 3, $81.50. We do the same exact thing with the expenses. We credit each expense account and debit the income summary. The income summary now has the net income of $37.85. Now we have to zero the income summary out. We're going to throw the balance is $37.85. So we move the $37.85 over to retained earnings, okay? The revenues were $81.50. The expenses were $43.65. There's our net income. Dividends, we close directly to retained earnings. A dividend automatically reduces retained earnings. That's why you close it to retained earnings. A dividend is a giveaway of company ownership in the form of cash, or it could be stock. Post-closing trial balance, huh? Are you surprised we have a post-closing trial balance? This is super easy. Once you have recorded the closing entries, the only thing left with a balance are going to be the permanent accounts. In other words, the balance sheet. So when you run the post-closing trial balance, notice there are no revenues and expenses there. What happened to those revenues and expenses that were there at the end of the month? Remember, we closed it out to retained earnings, okay? Steps in the accounting cycle. I'll let you look at this on your own. They're just saying analyze, journalize, post. We'll go over it quickly. You analyze it. It starts with analyzing a transaction, maybe recording a payroll. You write your journal entry. You post to the ledger. You prepare the unadjusted trial balance, which we learned last class. Now we get into the adjustments. We prepare an adjusted trial balance. We prepare the financial statements. We close the temporary income statement accounts, run our post-closing trial balance, maybe some reversals, and off we go to the next month. That's the accounting cycle. Okay, let's do a little bit of analysis of some balance sheet here. Explain and prepare a classified. Classified means you're going to have subtotals within the assets, within the liabilities, within the equity. The way we've done it up to this point is you have sales, and you just list them all and add them up, and you have expenses and you add them up. On the balance sheet, you've got all the assets listed, whether they're long-term or not. Here, we're going to have different categories, different subtotals, if you will. We're going to have something called current assets and non-current assets, and maybe long-term investments, plant assets, better known as fixed assets, intangible assets. Oh my goodness. And then on the liability side, we'll have current and non-current liabilities, okay? Let's see how well they present this for us. A current asset is one expected to be sold, collected, or used within 1 year of the company's operating cycle. 1 year. We sell something to a customer, and the deal is he's going to pay us in 30, 60, or 90 days. That is a current asset. A non-current asset, a long-term investment, would be not a current asset. It would have its own categories. A long-term investment is expected to be held for more than 1 year or the operating cycle. Perhaps we bought a block of stock in another company, or we bought a bond, a 3-year bond, a 5-year bond. That would be a long-term investment. Plant assets, excuse me, also called fixed assets, are tangible, long-lived assets used to produce and sell the product. Tangible, meaning you can touch it, you can see it, you can feel it, it's there. It's a physical entity, huh? Plant assets, they are a tangible, long-term asset used to produce or sell products and services. And guess what? We have intangible assets. What we're talking about here is really intellectual property. Intangible assets are long-term assets used to produce or sell products and services that lack physical form. What we're talking about here is a patent. You have an invention. You invent a new machine. You get the patent from the government. That is an intangible asset. You can't see the patent. You write a book. You get it published and copywritten. You now have the rights to that book. That's a copyright. You open up a McDonald's franchise and you put up the McDonald's logo there. That would be another intangible asset. That'd be a trademark, okay? We'll get into intangible assets in a future chapter. Just as we had current assets and non-current assets, we're going to have current liabilities and others. Current liabilities are due within the longer of 1 year or the company's operating cycle. We'll say 1 year. I don't think the book tries to fool us with operating cycle issues. Current liabilities. We bought something from somebody and the deal is we paid a guy in 6 months. That's a current asset, a current liability rather. The deal is we paid a guy in 2 years, which is possible. That's a non-current liability. That's a long-term liability, not due within the longer of a year or the company cycle. So it's always the 1 year that distinguishes a current asset or a current liability, okay? And equity is the owner's claim on the assets. It's the net worth of the company on paper. It's the assets minus the liabilities, right? Equal the equity. Do a little bit of brief analyzing here. Compute profit margin. Oh, this is the first thing investors look at, I bet, huh? When you're looking at a company, are they making money? Money is good. Profit margin. The profit margin ratio measures the company's net income to sales. So take a look at this. Net income divided by the net sales is going to give you a percentage. So here, this company here, Visa and MasterCard, huh? Visa had net income of $6,699 over sales of $18,358. And that gives you a profit margin of 36%. A year ago, 5,991 net income divided by net sales, 40%. And the year before, it was 46%. So those are pretty good margins, I would guess. What that means is after for every dollar of income, or rather every dollar of sales, Visa has 36 cents left over. They're bringing in 36% on their sales. That seems to me like a pretty good return. What if they decided to take that money and put it in the bank? They're lucky to get 1%. And if you look at MasterCard, their numbers are not quite as good. But it's interesting to note that the number is coming down. And there are probably reasons for that that I can't go into right now. But maybe people aren't using their credit cards as much. They're worried about inflation. The pandemic put people out of work for a while. And maybe they're just not generating the same volumes. Here's another ratio, the current ratio. Current ratio. Current ratio. Current assets minus current liabilities gives you something called working capital, okay? Current assets minus current liabilities gives you something called working capital. And you're looking to compare companies, and your company has $100,000 worth of working capital, and my company has $1 million worth. Am I doing better than you? Not necessarily. You can't compare. It's not easy to compare companies on a dollar for dollar basis. That's why we want to work with the percentages, the revenue. We're going to record what's called the current ratio. Simply current assets divided by current liabilities. Current assets divided by current liabilities. And here, Costco has a ratio of about $1, 0.99, 0.98. That means that they have slightly more liabilities than assets. Here is the only period of these 6 where it goes over 1. These are kind of low numbers. What this means technically is that Costco at that point in time would not be able to pay all of its current liabilities because they have more liabilities than the working capital number. And the same was true a year ago, and it was almost true here. And Walmart, the same thing. Now that makes me think that low current ratios are probably typical of a big superstore. I'm just throwing out an assumption there when I see these numbers, because most companies want them to be bigger than that. Current ratio. It's a measure of a company's liquidity, how quickly they can pay their bills. If it's over 1, you're okay. Below 1, you might have a problem. I'm going to cut this off now and not go into the appendix, okay? If my boss, if Cornelia instructs me, chastises me for not going into the appendix, I'll do another video and get it out to you guys, okay? When we get to the appendix, alternative method for prepaids, we don't teach that. The worksheet, we learn about the worksheet. The only thing worthwhile in there are the reversing entries, okay? So I don't think there's going to be any questions today since I'm the only one on the Zoom session. Where's my class? Are you guys all upset about the Super Bowl matchups now? You too angry to come into class? Anyway, you take care, everybody. I'll have this thing up by this evening, okay? Thank you.